Is Nvidia a buy at $100 per share? And if you want to build indestructible wealth, is Nvidia a good choice as a long-term investment? The only way to know is via fundamental analysis to find the intrinsic value. I spent the last week putting together a full fundamental analysis on Nvidia based on their recently reported 2024 results. Trading at $100 per share, I have a buy rating on Nvidia stock. In my research, I discovered 6 things that got me very excited and 4 red flags to watch out for with Nvidia. So what did I discover? What is my value for Nvidia stock? And what is an ideal entry point should you decide to become an Nvidia shareholder? Let's dive in, find out. In this video, I will cover Nvidia's recent results and what everyone is missing, what I think about Nvidia stock and what my analysis uncovered, what Wall Street's smart money says and how it can impact your portfolio, and how you can use this information to build wealth and what you must do if you decide to buy. Are you an investor in Nvidia stock? Why or why not? Let me know in the comments below. If you're enjoying this, please smash that like button. Nvidia recently released record-breaking 2024 results, and I'm going to break it all down for you. Let's cover the red flags first. Multiple governments are scrutinizing Nvidia's AI influence. This could lead to antitrust action or enforced licensing. New rules from January 2025, the AI diffusion IFR, are already affecting shipments to China, the Middle East, and more. This could severely limit global GPU exports. The good news is that China is 13% of revenue, and it's been decreasing over time. Gaming revenue was down despite strong end-user demand, mostly due to supply constraints. Future rebound depends on RTX 50 series adoption. 3 customers, Amazon, Microsoft, and Google, each make up over 10% of total revenue. If just one slows spending, it impacts the entire business. Here's what got me really excited. CEO Jensen Huang emphasized that this move will strengthen Nvidia's supply chain, enhance resiliency, and better position the company to serve the growing AI market. Taiwan Semiconductor is producing the latest Blackwell chips in Phoenix, Arizona. Nvidia is partnering with Foxconn and Winstron to establish supercomputer manufacturing plants in Houston and Dallas, Texas. Collaborations with Taiwan Semiconductor and ASML ensure access to cutting-edge manufacturing processes, including long-term access to leading-edge nodes 3 nanometers and below.
I got a ton of new tech.
NVIDIA GB200 systems are now deployed across AWS, Azure, and Oracle Cloud. Revenue surged 142% year over year to $115 billion, with $11 billion from Blackwell in Q4 alone, the fastest product ramp in company history. This is what everyone is missing. While the focus is on data center growth, automotive revenue doubled year over year. Toyota, Hyundai, and Aurora are designing their autonomous capabilities by adopting NVIDIA's drive platforms. When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's financial statements. Would you buy a house without knowing the size, location, dimensions, or condition?
I don't think so.
That is exactly what you're doing when you buy a stock without understanding the 3 financial statements. If you want to value companies like the world's top financial analysts on Wall Street, check out my school community Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. Cash is nearly 4x'd from 2020 to 2024. With over $43 billion, they are actively investing in research and development and returning capital to shareholders. Despite massive growth, Nvidia is not being funded by debt. In fact, cash is over 5 times larger than debt, and debt is declining. This gives the company financial flexibility to invest in the latest technology and expand globally. Retained earnings has grown rapidly, increasing more than 6 times from 2022 to 2024. Over the last 2 years, Nvidia has generated over $102 billion in net income while only paying $1.2 billion out as dividends. We will see this next in the income statement. So what's the takeaway? Nvidia is a company in hyper growth mode as AI becomes mainstream. With a conservative balance sheet that contains a stockpile of cash and very little debt, the company is poised to take advantage of growth opportunities. The income statement shows us how the company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profit is via margin. Revenues minus expenses equals income. Income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Annual revenue growth has averaged 120% over the last 2 years, going from $27 billion to over $130 billion. Once known for gaming, today data center revenue is over 90% of total revenue as demand for generative AI applications explodes. Gross profit has increased more than 6 times over the last 2 years, but gross margin has seen a downward trend over the last 4 quarters. This is primarily due to a transition to more complex and higher cost systems within data center. Nvidia has more interest income income than interest expense. Because cash far exceeds debt, they use the income from cash to cover the interest on debt. And net income has more than doubled the growth rate of revenues over the last 4 years, 16.8x versus 7.8x. Remember, revenue is what you make, net income is what you keep, so they are showing incredible operating efficiency. So what's the takeaway? The eye-popping growth over the last 2 years has been mind-blowing to witness firsthand, but as they transition to more normalized growth, they need to keep an eye on managing costs effectively. The cash flow statement tells us where the cash is generated by the company, and there are 3 buckets. Operating, which is the cash the company generates internally, investing, which is the cash demanded for long-term growth, and financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash, making this positive, not losing cash, which would make this negative. Free cash flow has increased 16 times over the last 2 years. The genius of Nvidia is that they outsource fabrication and manufacturing so they can focus on design, which is why we see low capex and high free cash flow. Something to keep an eye on are accounts receivable and inventories, which have resulted in a combined cash outflow of $24 billion over the last 2 years. The CFO cited increased inventory to support the Blackwell product ramp, but with rapid growth and high demand, it is important that Nvidia continues to manage operating working capital effectively. Like most of the Mag 7, with huge cash balances, Nvidia is investing that cash and returning massive amounts to shareholders. Proceeds from marketable securities over the last 6 years is $76 billion, while share repurchases and dividends combined is only $56 billion. They are literally investing cash, giving the proceeds to shareholders, and still have $20 billion left over. So what's the takeaway? Operating and free cash flow are positive and growing rapidly. With this abundance, Nvidia has rewarded shareholders by returning tons of cash to them, which is a huge positive. So what does this all mean for the valuation of Nvidia stock? Let's cover that next.
All right, you have my attention.
On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow, and we projected the 3 financial statements, we can take these future cash flows, discount them back to today to get a current intrinsic value of the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. If you want to learn how to value companies like we do on Wall Street so that you can build generational wealth, scan the QR code on the screen to join my school community, Win Like Wall Street. Also, you could check out the step-by-step video I did on building a DCF model, which includes an Excel file. The link to that video appears above and is in the description. As you can see on the left, we take specific line items that we projected from the 3 financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get the total enterprise value. We strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments, we get an intrinsic equity value of over $2.9 trillion. We divide that by the current shares outstanding, we get an implied share price of 120.59 compared to the current share price of 98.89. That's almost a 22% discount, which is a buy rating. On Wall Street, if a stock is trading at greater than a 20% discount, it's considered a buy because it provides us a margin of safety. So what does Wall Street have to say about Nvidia stock, and how can that impact your portfolio? Let's cover that next.
I'm all ears.
There's general optimism among major analysts regarding Nvidia's long-term prospects, despite some concerns about export restrictions and potential demand fluctuations. D.A. Davidson has a target of 135. They maintain a neutral stance, warning that hyperscalers like Microsoft and Amazon could eventually normalize their AI buildouts, potentially flattening Nvidia's sales curve. Barclays has a target of 155. They maintain an overweight rating, citing Nvidia's long-term growth prospects in AI, despite lowering the price target due to current geopolitical tensions affecting the semiconductor industry. Evercore ISI has a target of 190. They reiterated an outperform rating, emphasizing Nvidia's dominant position in AI and its potential for continued growth amid evolving market dynamics. CapIQ gives me a sense of how other analysts on Wall Street view the company. 54 analysts cover Nvidia on Wall Street. The target price is from a low of 115, which is a 16% increase, to a high of 220, which is a 122% increase. This is very rare because even in the worst case scenario, it's above the current share price. The median is 170, which is a 72% increase, and the overall rating on a scale of 1 to 5 is 1.43, which is a buy rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I do own a position in Nvidia, and under $100, it's an obvious buy at these levels. Nvidia is the smallest position in my portfolio at a current weight of 2%. If you decide to buy Nvidia, I'll tell you exactly how to build a position, which I'll reveal shortly. With GPUs taking over CPUs and high-performance workloads, Nvidia becomes the new Intel. It's becoming the infrastructure layer of the entire AI economy. Think of the AWS of computing. Enterprise AI demand nearly doubled year over year. Companies across healthcare, finance, logistics, and robotics are building large language models using agent-based AI and adopting NVIDIA's AI stack, opening multi-billion-dollar verticals. The Blackwell architecture generated $11 billion in Q4 alone, the fastest product ramp in NVIDIA's history. CEO Jensen Huang highlights that reasoning AI is the next big AI trend. Nvidia hit a 52-week high of 153.13 in early January 2025, and it's down more than 35% since then. My model shows a valuation of 121, which is a 22% discount at current levels. On Wall Street, we buy with a margin of safety of at least 20%. So Nvidia is a buy at current levels, and if you decide to add it to your portfolio, this is what you should do. Decide how much capital you want to allocate to the position. I typically choose 10% as a max, but start small and build over time. Utilize limit buy orders so that you're not chasing the stock. Break your purchases into pieces so that you dollar cost average into the position. If you like this and want to see another in-depth stock valuation, check out my PayPal video here or my Coinbase video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.